bonds are crucial for investment portfolios due to their stability and income generation. They offer fixed interest payments and return of principal at maturity, providing a predictable cash flow. While generally safer than stocks, bonds still carry risks such as interest rate fluctuations. Investors often include bonds for diversification, balancing risk, and preserving capital. Overall, investing in bonds can be prudent for those seeking a more conservative approach to wealth accumulation, especially during periods of market volatility. In this video, I'll explain the idea of a financial bond in a simple way. I'll cover what a bond is, how to choose investment bonds, and share practical tips on including bonds in your investment portfolio. I'll avoid using complex financial terms to make it easy for beginners in money and investing. Let's start with the basics. What is a bond? A bond is like a loan that you give to someone and, in return, they pay you interest. When the loan period ends, you usually get back the original amount you lent. We all have experience with bonds in everyday life. For instance, when you lend money to a family member or help out a friend who forgot their wallet. The only difference is that, in formal finance, bonds are a legal agreement between the lender and the borrower. If the borrower fails to repay, the lender may have the right to seize their assets to recover the money. This makes bonds generally seen as safer investments compared to stocks. In contrast, buying stocks doesn't give you a legal claim to anything. Stock investors only profit if the company succeeds and makes money. If the company goes bankrupt, stockholders may lose their entire investment without any legal recourse. On the flip side, if the company thrives, stockholders enjoy all the benefits and potential riches. Bonds, on the other hand, offer a more predictable return. You receive your interest and your principal, but nothing more, regardless of how successful the company becomes. For example, take Apple, a company that issues both stocks and bonds. If you buy Apple stock, you become a part owner and share in the company's success. If you opt for Apple bonds, you become a lender, but the returns are typically lower. As of now, Apple corporate bonds yield less than 2%. So while bonds provide stability, investing primarily in stocks offers greater growth potential. Now, let's discuss how to choose bonds in simpler terms. When deciding on bonds to invest in your portfolio, there are two key things to consider: creditworthiness and yield. Firstly, creditworthiness is crucial. This means assessing the financial health of the borrower. If the borrower is in good shape, your investment is relatively safe, and you're guaranteed interest payments and the return of your principal. However, if the borrower goes bankrupt, there is a risk you might not get your money back. Therefore, as a bond investor, it's essential to research and invest in your creditworthy bonds. To measure creditworthiness, you can rely on credit ratings provided by independent agencies such as Moody's, Standard & Poor's, and Fitch. For example, at Standard & Poor's, AAA is the highest rating, indicating very creditworthy and safe bonds. On the other hand, C is the lowest rating, suggesting bonds are already in default. Ideally, as an investor, you should focus on investment-grade bonds, typically rated BBB and above. Anything below BBB is considered a junk bond, carrying higher risks. Another factor to consider when evaluating bonds is the yield, which is the percentage that indicates the return on your investment. A higher yield means more return, but it also comes with higher risks. While a 20% yield might seem attractive, it often suggests a poor credit rating for the borrower. In such cases, the high yield is offered to attract lenders due to the increased risk associated with the investment. So, as an investor, you aim for a balance between a good yield and the creditworthiness of the bonds you choose. When you're dealing with bonds that offer very high yields, it might seem tempting to go for that 20% return. However, there is a significant risk involved. While you may enjoy a high yield for a period, there's a good chance that the entity borrowing the money could go bankrupt, leaving you without your initial investment. For instance, consider Argentina's government bond, currently offering a 44% yield compared to US Treasuries, which provide less than 1%. This difference underscores the importance of creditworthiness. Argentina has defaulted on its debt at least 8 times, while the US has never defaulted. Argentina's credit rating, according to Standard & Poor's, is a D, the lowest possible. Despite the attractive 44% yield on Argentina bonds, there's a substantial risk of not recovering your principal. In essence, the key takeaway is that there's typically an inverse relationship between yield and creditworthiness. Higher yields often come with lower creditworthiness and vice versa. If an investment seems too good to be true, it probably is. As you move down the credit ratings, you approach junk bond territory, requiring more caution. While you want bonds to provide a high yield, it's crucial to balance that with the need for a secure investment. If you decided to include bonds in your portfolio, there are two ways to do it. You can either invest in bonds by purchasing a bond fund or buy individual bonds. Regardless of your choice, you'll need an investment or brokerage account. Reputable brokerages like Fidelity, Schwab, or Vanguard are ideal places for these transactions. A bond fund involves bundling various bonds into a single investment vehicle. These funds often include hundreds or even thousands of different bonds, offering diversification. The benefit of diversification is that your credit risk is spread across multiple borrowers. For example, consider LQD. But before we disclose this wonderful thing, don't forget to like this video if you found it helpful and subscribe to my channel for more insights. LQD is a bond exchange traded fund, or ETF, that holds over 2,000 different bonds. This makes it a diversified bond fund, spreading the risk among many borrowers. If one of the 2,000 bonds defaults, it won't significantly impact the value of the bond fund or your investment. It's like finding safety in numbers. Additionally, bond ETFs make it convenient to invest in bonds compared to buying individual ones. Buying individual bonds often requires meeting investment minimums, usually starting at $1,000 and incurring fees and commissions. Unless you're an advanced investor with a lot of money, it makes more sense to invest in bond funds. When researching bond funds, you'll notice two main categories: government bonds and corporate bonds. Government bonds are issued at governments at various levels, like U.S. Treasuries issued by the U.S. federal government. IEI is a bond ETF investing in U.S. Treasuries. LQD, on the other hand, contains corporate bonds. Corporate bonds involve lending money to corporations, and since corporations are more prone to bankruptcy, their yields are usually higher than government bonds. For instance, IEI, the U.S. government bond fund, yields around 0.59%, while LQD, the corporate bond ETF, yields much more at 2.25%. In summary, corporate bonds offer higher yields, but they come with higher risks compared to government bonds. The choice between the two involves a trade-off between creditworthiness and yield. If you prefer a safer option, sticking with government bonds is recommended. This concludes my beginner's guide to Bonds 101. In essence, a bond is a loan exchanged for interest, forming a legal contract between lender and borrower. Bonds are generally considered safer than stocks, ensuring the return of both interest and principal as long as the borrower remains solvent. I've highlighted the importance of evaluating a bond's creditworthiness, typically assessed through credit ratings from agencies like Moody's, S&P, and Fitch. The safety scale spans from AAA, the safest, to C, the riskiest. Also discussed the delicate balance between bond yield and creditworthiness, noting that the riskiest, least creditworthy bonds generally offer the highest yields. I underscored the importance of evaluating a bond's creditworthiness, a task often carried out through assessments provided by credit rating agencies such as Moody's, S&P, and Fitch. The safety spectrum spans from AAA, denoting the safest, to C, indicating the riskiest. Additionally, I delved into the intricate interplay between bond yield and creditworthiness, noting that the riskiest bonds, those with the least creditworthiness, typically present the highest yields. In the course of our exploration, I shed light on the two distinct avenues available for bond investment, namely bond funds and individual bonds. Particularly for those new to the investment landscape, I recommended starting with bond funds due to their inherent advantages, including diversification, cost efficiency, and overall convenience. To summarize, bonds assume a pivotal role in the composition of any investor's portfolio. The insights shared here will prove beneficial to you in the years ahead. I have covered the fundamentals and benefits of bonds, but now it's your turn to dive deeper. What type of bonds are you considering for your portfolio? And what questions do you have about integrating them into your investment strategy? Share your thoughts in the comments below. Happy investing, and may your financial journey be prosperous. And if you are interested in wealth building at a young age, I insist you watch my video on the best kind of businesses you should start right when you are in your 20s.